The Chinese real estate market, valued at $62 trillion, the largest asset class in the world, is collapsing as we speak. In fact, the stock of Evergrande, which is one of the largest real estate developers in China, was down over 87% just the other day. Yes, you heard me right. In one day, the stock was down by 87%. So this begs the question, okay, well, if the crash in the US real estate market triggered the first GFC, is the collapse in the Chinese real estate market going to trigger GFC 2.0? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go right to the internet and see just how big this problem actually is. So now we fast forward to a more recent article titled "China Tries to Diffuse Economic Fears After Developers' Debt Struggle." And that's an understatement. Their whole entire real estate market is in the process of crashing, maybe even more severe than we saw in the United States 2006 to 2012 during GFC 1.0. But this article points out Country Garden, they're China's largest real estate developer, and now they're having the exact same problems as Evergrande. And we saw a report, I guess according to this article, it came out in June, that said they lost $81 billion but just between 2021 and 2022. It said both ran into the same problem. Now, this next sentence I want you to pay very close attention to, because this really distills the problem down to its core. So it's very easy for everyone to get their head around. These real estate developers in China, have more assets than debt, but can't turn slow selling real estate into cash fast enough to repay lenders. Does this sound familiar? Remember Silicon Valley Bank? Why did they go bust? They had the assets to match the liabilities. But what happened is they had to fire sell those assets and take a haircut. And of course, we're talking about treasuries. If they could have just held those treasuries to maturity, there wouldn't have been a problem. But they had to sell them before they matured. They had to take a haircut and sell them for, let's say, 50 cents on the dollar. That wipes out their equity. Boom, they're bust overnight. And it's the exact same thing with these Chinese real estate developers. They have the assets on their balance sheet, these apartment complexes, but they've got to sell them at 50 cents on the dollar, just as an example. That wipes out their equity, and boom, there you go. They're the next Silicon Valley Bank, Credit Suisse, Signature, First Republic, etc. Or maybe better said, they could be the next Bear Stearns and Lehman Brothers. Step number 2. So now let's try to answer the question, could the real estate market collapsing in China lead to the next global financial crisis? Well, to start, we've got to understand what happened during the first GFC, GFC 1.0. So it starts with the government. I know you're all shocked. And then your drunk, insolvent Uncle Sam goes on the mainstream media, CNN, Fox, MSNBC, and says every single American should own a home. It's a right. It's the American dream, for heaven's sake. And then behind the scene, he's going to all of his buddies at the banks and saying, hey, listen, you need to give a mortgage to anybody that can fog a mirror. And they say, well, we're not going to do that because we're not going to get paid back. We're going to go bust. And they say, no problem. You can take those mortgages and just pawn them off on Fannie and Freddie. And if they go bust, the taxpayer will have to pay the price. They say, sounds like a good deal. We have no downside and only upside. So they go out and find any average Joe, or in this case, your friend and family member Fred, and they say, hey, how would you like a mortgage? Now, we all have a friend and family member Fred. That's someone that we know that really shouldn't have credit. They shouldn't have debt, but they do. I mean, just watch an episode of Dave Ramsey and you know exactly what I'm referring to. So the banksters go to friend and family member Fred. They say, hey, here's $1 million. Go buy a house. He buys a house, can't afford the payment. Everyone assumes that housing prices are going to go up forever. They don't. You guys know the story. And we have a big problem. Well, this big problem results in the banks tightening credit. So if you're a bank and you're going through 2008 or 2009, you're going to be risk off. They just got absolutely burned. They're looking out at the economic environment. They think the world's coming to an end. So the last thing that they want to do is extend credit, provide dollar liquidity, or create any more loans to give any more mortgages. So this doesn't just impact your friend and family member Fred trying to buy another house in, let's say, 2009 or 2010. This impacts the entire economy because you've got other banks that need to borrow from the banking system. You've got corporations, you've got businesses, small and mid-sized businesses that need credit to make payroll or whatever it is just to run their business. And then we've got this guy right here, Productive Pete. He represents all the entrepreneurs in the economy. He's got a great idea. He wants to build a business, create more widgets, provide goods and services that raise the living standards of everyone in society, but he needs to borrow some money to get this idea off the ground. Well, he goes to the banks and they tell him absolutely not. They aren't extending credit to anybody. So what happens is all of these entities in the private sector, the real economy, well, they're the job creators. So if they can't get the credit they need to run or start a business, then they have to lay off employees. They can't hire as many. Therefore, the unemployment rate goes up. If the unemployment rate goes up, what happens to aggregate demand? It goes down. So if aggregate demand goes down, if these people have less purchasing power, then that means more people can't pay their mortgage, they can't pay their bill, they can't pay their auto loan. So then, and less overall spending in the economy, which is 70% consumption. And then it just goes right into this big doom loop where the problems that were originally created by the government now become problems for the banking system, which is a problem for the economy, which makes the banking system even less willing to extend credit. Now we need to look at this through the lens of the global monetary system. And we're going to keep it super simple. So we had these mortgage-backed securities that blew up. Pretty self-explanatory. But what we have to understand, these mortgage-backed securities were collateral for the global monetary system. As an example, we have this bank that goes out, let's say they go to the repo market because they need some dollar liquidity. Well, they're going to pledge collateral. That could be treasuries, or at least prior to 2008, that could be mortgage-backed securities. So almost overnight, we have the amount of collateral because of this process that we talked about earlier with these mortgages blowing up because of your drunk insolvent Uncle Sam. There goes my pen. We'll get that later. So because your drunk insolvent Uncle Sam creates this disaster, we had the mortgage-backed securities blow up, which means almost overnight, we have a lot less collateral in the system. So a lot less collateral means a lot less credit. This means a shortage of dollars, and the economy doesn't have the liquidity it needs to produce the goods and services that it was producing earlier. So we can also think about this maybe more specifically. I think this is the key to the whole entire step, and we're going to go over this in step number 3. But the key here is to really understand that it's not necessarily just a shortage of dollars. I mean, we kind of say that a lot on this channel, or you hear Jeff Snyder talking about that. But maybe better said, it's the shortage of dollars that are actually circulating. So you could see M2 money supply skyrocket, like we saw in 2020 and in 2021. But if those dollars aren't going out to the businesses and the real economy that need those dollars to function, it would be the exact same as you taking those dollars and just stuffing them under your mattress. It doesn't do any good, and the net result is the same, which is an economic collapse, or maybe said another way, a global financial crisis. Step number 3. Now let's go over how this could play out. How could the collapse in the Chinese real estate market lead to the next GFC? We'll call it the Global Financial Crisis 2.0. So we start by going over, well, this red blob that is obviously China. You can see my artistic ability shining through right here on the whiteboard. And we've got the real estate developers that we were talking about earlier, companies like Evergrande and Country Garden. So they're kind of at the core, but I want to point out that the whole Chinese economy is really struggling right now. It's not just the real estate developers. So let's look at an aggregate balance sheet for, let's say, all of the entities in China. We've got assets on the left, liabilities on the right. And let's say they've got about $5 trillion of dollar-denominated debt. And that's probably lowballing it. But they'd have $5 trillion in assets as well. But if the entire Chinese economy is collapsing, then they're going to have a much harder time paying back those debts, especially the dollar-denominated debts, because most of their cash flow is coming in yuan. Okay, well, let's think this through. We've got these banks in the Eurodollar system. We'll call them Bank A, B, and C. They lent all these dollars into China, represented by the big dollar signs, but what they're getting back is a lot fewer dollars, represented by the little dollar signs. So they lend a big dollar sign and they get back a little dollar sign. Well, that's not good if you're one of these banks. And that creates an environment very similar to what we saw during the GFC 1.0. How? Because it goes right back to the key talking point here. And this creates a lot less dollar liquidity. So not just a shortage of dollars, but a shortage of dollars that are actually circulating. This is key. And this is why I always say it really isn't the central banks, the Fed, the PBOC, that is at the center of the monetary solar system. It's actually the banks in the Eurodollar system. If they aren't functioning, the whole house of cards collapses. Oh, but wait, there is more. Unfortunately, that's not the only problem. We've got those banks in the Eurodollar system that we talked about before, Bank A, B, and C. So now that we've got the problems with China, some of these banks are going to go bust. So we'll just say that A is no longer there. And B and C are going to have massive cracks. They're going to be risk off for obvious reasons. So they lent all these dollars, not just to China, but into the global economy. Okay, well, the global economy consists of all these businesses, just like Evergrande and just like Country Garden. So if they're not getting the dollars they need to service these debts, what do they have to do? They have to sell other currencies on their balance sheet in order to get those dollars. So as an example, China's Evergrande or Country Garden, they most likely have yuan on their balance sheet. Or you look at a real estate developer or an entity in Japan, they'll have yen. Or Mercedes-Benz, let's say, in Europe, they would have euros. Or an entity that creates widgets in the UK, they would have pounds. So if they're short on dollars because of this system breaking down that provides dollar liquidity, they're going to have to sell those currencies on their balance sheet to buy the dollars they need. Okay, but what is this going to do to the value of the dollar relative to those currencies? The dollar is going to continue to go up and up and up. In this case, we're just using the example of the dollar versus the yen. But if the dollar goes up in value, that means the dollar-denominated debt becomes even more of a burden for these entities to pay back that are short on overall cash flow, not just dollar cash flow, because of what's happening with the collapse of China that's going to have a ripple effect into the global economy. So if these currencies are devaluing relative to the dollar, meaning the dollar is going up in value, which is making these burdens of debt even more cumbersome, then that means the defaults are also going to increase, which takes us straight back to this shortage of circulating dollars because of the hole that's being blown in the balance sheet of all these banks in the Eurodollar system. But let's not forget, while this is all happening, Jerome Powell is increasing interest rates. And he's increasing interest rates at the Federal Reserve for the U.S. domestic economy. But what does this do? This increases the interest rates for all dollar-denominated loans, even outside of the United States. So if one of these entities are able to actually roll over their debt, they have to do it at even a higher price or a higher interest rate, the cost of money. But it doesn't end there, because these banks, even if they are willing to extend credit, they're going to do it at a higher risk premium because the amount of perceived risk out there in the global economy is increasing. Therefore, in order to extend that credit, they have to have a much bigger buffer. So you have Jerome Powell increasing interest rates. You have the risk premium increasing as well. So if an entity was able to borrow a couple years ago at, let's say, 3 or 4%, now it's going to be 9 or 10%, to the point where they can't even afford to roll over that debt. It isn't possible. And if they can't roll over the debt, it takes us straight back into more defaults, which goes right back into an even bigger shortage of circulating credit. This is exactly what happened during the GFC. And although history doesn't exactly repeat, this time it definitely might rhyme. In other words, we all know that the real estate crash in the United States triggered the GFC 1.0. But after we go through this thought experiment, we can see how it's definitely possible that the real estate crash in China could trigger the next global financial crisis. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.